This is the current federal tax developments for the week of April the 27th, 2020. Current federal tax developments are brought to you each week by Kaplan Financial Education and by your state society of CPAs. This week we're going to look at some more developments in the week that brought us back to more funding for the Payroll Protection Program loans. So those are about to restart on Monday. And then we'll talk about some of the other developments we have. We've had more guidance issued on the Payroll Protection Program. We've had action taken regarding the access to such funds by some taxpayers that certain people have decided that maybe they shouldn't have been applying. And so we got some guidance on the meaning of the word necessary and how your certification that the loan was necessary may come into question. We also have some relief granted to both people who are non-U.S. citizens trying to avoid U.S. taxation by being in the U.S. too long, being trapped here, and issues being generated for U.S. taxpayers who are planning on qualifying for the foreign earned income exclusion but got forced back to the U.S. before they could meet the qualifications. We'll also take a look at some additional procedures for taxpayers who aren't required to file but want to get set up for the CARES payment and don't want to just go in and give their bank information to the IRS as somebody who didn't need to file. And we'll also go back to a topic that we visited here a few times over the years that mainly impacts the state of Connecticut, but PYRRHOTITE damage is back in our broadcast for another week. So we're here looking at the PYRRHOTITE issue that we've looked at a few times in the past. We're going to get a look at it again here today. So with that, let's start out with what was probably the big story toward the end of the week, was that we got funding restored for the paycheck under a bill called the Paycheck Protection Program and Healthcare Enhancement Act that was signed into law by the President on the 24th of April. This adds to the Payroll Protection Program Loan Fund $310 billion. Now remember, it was originally funded with $350 billion. That money ran out. We had a big fight in Congress about whether they were going to pass just a straight up add $250 billion to it or whether the program that would be passed would have other features. We finally got a decision where certain other items got added, but not as many as the Democrats wanted. So we end up with, as probably, at least to me, watching the Hill for a number of years, not unexpectedly, after a lot of pushing and shoving and taking positions that we knew the other side wouldn't agree with, we finally cut a deal by the time the pressure got high enough. So a deal was cut. We do have $60 billion that's been reserved for smaller lenders and underserved population, so that was part of it. So essentially we got the $250 that the Republicans were asking for, then we got another $60 billion that addressed the fact that there was some belief that certain people were shut out of access to it that shouldn't have been, and we also got a few other things in there. Another thing we did get was $10 billion in funding for the emergency grants, EIDL grants. Remember those that up to $10,000 don't have to repay them. We found out later to the SBA they're going to be $1,000 per employee. Originally $10 billion was allocated for those grants. That was used up. So we come back now, we put another $10 billion in the pot. The SBA will begin processing approvals again at 10:30 a.m. on April the 27th. It's not clear how long these funds should last. I've heard some projections that they would last maybe 10 days before we would run out of money again. So we may be back here shortly doing this whole funding it up again one more time as we see how things run. Now, we also had a number of new frequently asked question items and a new interim final rule posted on the payroll protection programs by the SBA. A number of pieces of guidance came out late in the week. So the first thing is we're going to talk about these additions that were made on the 23rd and 24th. On 2 straight days, we had additions made to the frequently asked questions for the payroll protection program. And one of the key ones was the first one that we saw that came out, that was the question 31. Right? Good old question 31. Question 31 dealt with the question of whether or not we had to worry about these certifications. In essence, did a company need to have been harmed by the COVID-19 situation in order to apply for this loan. Now, Senator Rubio had been saying in his tweets for a while, after word came out about loans being taken out by Ruth Chris, also by Shake Shack and Potbelly, he had been saying that no, you had to show need. That was in the law. And if you didn't show need, that you were making a false certification. Now, that would be somewhat significant because giving false information to a bank for the purpose of getting credit is kind of what under federal law is the basic definition of bank fraud. So we have a little bit of a high-stakes game going on here. And a lot of people were not happy with that reading, to put it mildly, because a number of people looked at the law as written and felt that it wasn't clear that you had to actually have COVID-19 harm. And the question comes down to your certification, and this is why I say the word necessary becomes significant. You had to say that the current economic situation generated by the COVID-19 situation made necessary the application for this loan in order to, sustain your continuing operations. And what appears to be the key aspect here, and this is where this comes from, is a focus on the word necessary. And in question 31, which was later backed up by interim final guidance, we actually got this emphasis on what's necessary, on the necessary requirement, and what that means and how you determine it. Key in question 31 that was asking if a business owned by a large company with adequate sources of liquidity to support the business's ongoing operations qualify for a PPP loan. The answer to that question was going to be a straight no. Let's be honest, when it's phrased that way, you kind of saw where this was going. But they did say specifically here, which is key, borrowers must make the certification. The certification is the current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. That certification became the big fight. And according to the SBA, a borrower must make the certification in good faith, taking into account their current business activity and their ability to access other sources of liquidity sufficient to support their ongoing operations in a manner that is not significantly detrimental to the business. For example, it is unlikely that a public company with substantial market value and access to capital markets will be able to make the required certification in good faith, and such a company should be prepared to demonstrate to SBA upon request the basis for such certification. Now, that's significant because it's effectively saying that we don't think a large public company, and a little bit open what that might mean, should be able to get this loan, even if technically under the sizing rules, because we had special rules for restaurants and hospitality groups that went to a location, more than 500 employees a location instead of more than 500 employees general, whether or not they might qualify. So that was kind of the issue. Okay, that's how we got to this certification problem. Now, they go on to give us an out, and a number of these companies have resorted to giving the money back. And the SBA is encouraging this. And what they've said is any borrower that applied for a PPP loan prior to the issuance of this guidance and repays the loan in full by May 7, 2020 shall be deemed by the SBA to have made the required certification in good faith. In essence, anybody who just gives it all back by May 7th is not going to face this question. If you made the certification in good faith, then you didn't give false information to the bank, and because of that, you're not going to be in trouble. So what they're saying is you got till May 7th. After May 7th, you have been forewarned that you may be asked to justify why the loan was necessary. Now, the real question we're going to face here is, how far do they go with this? Is this merely going to be limited to chasing back Ruth Chris and Shake Shack and Potbelly, organizations that for the most part now have scrambled back and put the money back in? I recall at least, Shake Shack did before any of this began breaking once they saw the news story. Ruth Chris, after this came out, did it. I don't recall hearing about Potbelly yet. but we've had some others that did it. There are some public companies that are holding on to the money, but I noticed the ones we've been told are going to keep it are all companies that don't really sell a lot directly to consumers, and that's probably a significant difference because the PR hit won't be as bad if you're not selling directly to small businesses and consumers. If you are hoping to get small businesses to entertain clients by coming to your restaurant, that may be a bigger problem if you take the PR hit. So, we'll see what comes of this. But you should at least discuss this issue with your clients. You should at least the client should have a good reason if asked, why was this loan necessary? In some cases, it will be obvious. You have a restaurant that has been shut down, for the past 3 weeks. You don't have money to pay the rent. You don't have money to pay payroll, right? That would look like, yes, the need's there and the necessity's there, so we should be able to get the loan. But conversely, if your company, let's say, has payrolls over 8 weeks, that maybe, let's say, your total payroll is going to be $50,000, and you've got $400,000 in the bank, then they may be a little more like, well, do you really need it right now, or do you have the liquidity to ride this out, especially if you also have a credit line of $1 million that doesn't have anything drawn on it currently. And I realize you could lose that credit line, but the basics is, does it look like you have access to credit markets, and can you do it? I'm not sure, but I would certainly warn clients that this question now may be put forward. It's become an issue. When Senator Rubio discussed it, he said directly an entity of any size needs to be able to justify this. So I think he's anticipating that there will be some other companies that will be discovered by the press to have taken this payment that don't look like they're needy. And so he's ready to say, look, I said anybody had to do this. So be aware of it. We got the second FAQ that came out on the 24th, was a little more interesting. Now, this one came out and added a number of questions and a number of clarifications, right? So what we got in this initially was that we were told, one question was answered by this, was that housing allowances are now considered compensation. There had been some discussion, if you are paid a housing allowance, which would be a taxable or a non-taxable one, did that get added to compensation? And if it did, was it considered cash compensation, part of the $100,000 cap, or was it considered to be non-cash compensation? So what the IRS has ruled is, or I should say what the Treasury has ruled, is that that is compensation per se. So it counts, but it's a payroll cost, but it is cash compensation because it's a housing allowance. And the cash compensation would be subject to the $100,000 annual limit per employee. So kind of good news, bad news, shall we say, in that realm. It's not going to be considered an add-on cost. We also were told how to determine if a principal residence of an employee is in the United States. We were told to go look at the guidance that exists in the Internal Revenue Code, in the regulations under the IRC. They basically send you to regulation, in essence, 1.121-1B, which is the exclusion of gain on resident regulation is where they're hiding this. But that's where you're going to go to see if the principal residence is in the United States. That would be a section defining what is a principal residence of a taxpayer. So the assumption is you may have a taxpayer with a residence both in the U.S. and outside the U.S. And is the employee's residence, principal residence in the U.S.? That would be your key test. It tells us and verifies that agriculture producers, farmers, and ranchers are eligible for the PPP loans, as are cooperatives. Agricultural and other cooperatives will qualify for the loan. Right? We also got the fourth interim final regulations that came down. And this has a number of special rules in it. One thing it tells us right away is that hedge funds and private equity funds are not eligible businesses. The position here is that they are not considered to be they're primarily engaged in investment or speculation, and they're not eligible to receive a PPP loan. They also said that if you're a portfolio company of a private equity fund, you need to carefully consider question 31. Do you have access to capital that would enable your continuing operations? In essence, you have access to the private equity fund. They could fund you to get you through this. So you can't just say, well, yeah, but they'd prefer we got quote-unquote free money. Yeah, that could be a problem. So basically you're saying you have to justify it. There was a ruling for a hospital that is owned by a governmental entity. And they decided such a hospital can qualify to receive this benefit because governments generally can't. But such a hospital, if more than 50% of its funding basically is, or say less than 50% of its funding, comes from state or local government sources exclusive of Medicaid. So basically, if paying for services, if the local government ends up effectively putting money in and subsidizing it, so it goes above 50% as coming from the government's money, then that's a government entity. It can't get the funds. But if more than half of its revenue is coming from basically patients, including those who are on Medicaid, but they're essentially patients, then it can qualify and it could get a PPP loan. That would be one of the things involved. Also, they clarified that the legal gambling business is allowed to get a PPP loan. They've clarified that one. An ESOP does not cause problems with affiliation rules. They talk about that there. They also tell us that an entity in bankruptcy is not eligible to receive a PPP loan. And in fact, if somebody applies for a PPP loan and then before receiving the funds files for bankruptcy, they have to tell the bank and the SBA that they have filed for bankruptcy and they must, or they've been forced into bankruptcy in an involuntary proceeding, and they will not be allowed to get the funds. We're going to lose the funds if that happens. The regulation also formalizes that May 7th safe harbor. Remember I said pay it by May 7th and it's deemed that you had good faith? That's written into this reg. So we now have a regulation that actually brings up that May 7th date for repaying. And then finally, which is kind of interesting and sets up a whole bunch of other things to happen, is they tell us specifically that things that changes to this or additions to this or clarifications to this can be posted on the SBA website, and as well that questions about issues should be directed to the lender relations specialist in the local SBA field office. So they're setting themselves up for what we've talked about in tax as sub-regulatory guidance that they will then try to expand upon in order to flesh out the rest of the program. The one thing we're still missing is any guidance on how borrowers are going to be able to compute that amount of forgiveness, the spending on that. What exactly counts, what doesn't count, how do we do things? All of that is still missing at this point in time. And there are a lot of unanswered questions there, and they still remain unanswered as of today. So if you were hoping we would get all that in this, well, yeah, that didn't quite happen. Okay, let's take a little bit of a break from COVID-19 just for a second and revisit something that's come up multiple times in the past on this program. This is the PYRRHOTITE foundation damage happening in the state of Connecticut. As you're probably aware, we've talked about this before. Turns out a number of homeowners in Connecticut discovered their foundations were crumbling. It turns out that was related to the presence of a mineral called pyrrhotite, which as I recall is what we normally refer to as fool's gold, that is in the concrete mix. And if that's in there, that will cause premature deterioration under the conditions you're going to find there. Well, that means, your foundation crumbles away. It's not good for your home. So there's some expensive repairs. So we continue this saga of the crumbling foundations. The IRS had previously issued guidance allowing homeowners to claim casualty losses in Revenue Procedures 2017-60 and then 2018-14 that gave them kind of a temporary additional break, even though the Tax Cuts and Jobs Act said that you couldn't claim casualty losses if it didn't arise from a natural disaster. They're now saying, well, yeah, but this one will let through. So it was kind of an interesting quirk. Well, in the interim, what's happened is, and we brought this one up before, the state of Connecticut had set up an insurance company to reimburse homeowners, to help them pay for this, the remediation necessary to fix these foundations. And you could either take what was essentially, you could be reimbursed for your payment, which you already paid, or you could have them pay a contractor. There was a certain limit for the maximum reimbursement that I believe was $275,000. And the IRS had previously said, well, if you claimed the casualty loss and then you filed the claim with these guys and they paid it back to you, then you had to consider the fact that you had to recognize that as income because you had received a tax benefit. This announcement tells us, okay, we know that we look at Section 111 if they had previously claimed a deduction and now they're reimbursed, and we look to see how much tax benefit, how much of their deduction gave them a tax benefit, and we pick that back up in income. We pick up the amount of reimbursement or the amount of tax benefit, whichever is lesser in their income when they get reimbursed. But what happens if they had never, they'd never claimed the deduction? They just went to the state, asked the state to pay the contractor, and the contractor fixes it. Do they have income under Section 61? Did they have an accession to wealth? And the IRS decides in this case that the answer is no. They did not have an accession to wealth, so we're not going to have them pay tax on it. Now that seems kind of obvious, if they got a deduction for it, and then we turned around and recaptured it if they got reimbursed, it would seem weird for people that had never claimed the deduction or had an attempt to claim a deduction to suddenly have income that wouldn't, that basically didn't exist the other way when we net it. So it's not surprising, but it is an issue that just hadn't been totally clarified. Now it's been clarified. As I recall, it was some members of the Connecticut congressional delegation that specifically asked for this from the IRS, so the IRS provided it. Now let's go to Revenue Procedure 2020-27, issued on April the 21st. In the Revenue Procedure, we're going to provide some relief for people who are trying to get the foreign earned income exclusion or the housing exclusion. What you do, Form 2555, you remember that form? Well, the problem is you can only get that if you essentially either meet the bona fide residence test or the physical presence test. And both of them have issues that you need to be present for a certain specific period of time in the foreign country. Not, being back in the U.S. causes problems eventually for both of them. Well, now the problem was I had been overseas. I was going to be able to use the foreign earned income exclusion, but then, here comes the coronavirus. And now suddenly I had to go back to the U.S., right? I was shoved back to the U.S., forced back, told to come back home early. Now the problem is my earnings while I was overseas are now going to apparently be fully taxable, subject to the foreign tax credit, being able to maybe solve the problem or not. Well, I probably prefer the foreign earned income exclusion entirely. Normally, not always, but usually I would prefer that. So what this provides is a special rule. We're going to cover you if you left China after December 1st, on or after December 1st, 2019, or any other country on or after February 1st, 2020. The period from that date, the date you left, until at least July 15th, 2020, is not going to effectively count against you for being in the U.S. That's going to be considered to be, you plan to be in the foreign country. It's going to assume you are still there, quasi, during that period. Now, they could extend this, but this is your relief for the foreign earned income, right? And they go through the math of how this relief would apply to testing the periods in the revenue procedure. You want to go take a look at that. We have another thing that came up here, Revenue Procedure 2020-28, because, we got new revenue procedures this week. We're having quite a few. This is for somebody who's not required to file in 2018 or 2019, does not want to use the non-filer's website to enter the payment information, but wants to go ahead and file a return. But they're not required to file a return. So the IRS has set up special procedures. Now, in reality, they still kind of prefer you go online and just use that special fill-in thing that said I wasn't required to file, here's my banking information. But if that's not going to be the way you're going to do it, you can file a special 2019 return using either paper or electronic methods. And what they tell you to do is what you provide on the return. It provides simplified procedures, and there are some different procedures if you're e-filing 0 AGI versus non-zero AGI. If you're e-filing 0 AGI returns, then they tell you to effectively just create $1 of income. Let's be honest, that's how you get there. Plus tell you the other specific things to put on the return. If you are not a 0 AGI person, but your income's still low enough you don't have to file, then they also tell you how to do a reduced return, and you again basically put in $1 worth of income. We don't really care what your other income is. And what this revenue procedure does, because we know that that's not a correct return, the revenue procedure essentially blesses that return and says the IRS won't question the numbers on that particular return. Now, obviously, if it turns out you really had $1 million worth of income, that's a different issue, but they won't come after you for falsely filing this return. They will come after you for just not reporting. That'll be the big problem. So you could still end up in the federal pen, you understand, but at least we're not going to ding you for saying that you said you only had $1 of income. Now, the IRS also provides, I told you there was a second relief provision in here for people who were non-U.S. citizens who were in the U.S. and got trapped here due to travel problems from coronavirus. Well, this is Revenue Procedure 2020-20, also issued on April the 22nd. This covers foreign individuals that were stuck in the U.S. due to travel issues related to COVID-19. It runs for up to 60 days for a period beginning on February 1st of 2020 and ending on or before April 1st, 2020. So remember, this period's already over. But because people had trouble getting flights out of the U.S., the problem became to try to get back to wherever, France, get back to Spain, get back to Singapore. You had trouble getting back wherever. Now, this could be a problem because if you stay in the U.S. too long, there is the substantial presence test that will convert you to a resident alien. And residents of the U.S. pay tax on worldwide income, and that's kind of a bad thing, at least if you don't want to pay tax to two countries on the thing. So what we're going to have is they come up with this COVID-19 medical condition travel exception. They go under the standard medical condition rule. And you're going to be granted, they tell you how to do it in this particular ruling, to apply for this special up to 60-day period that will be treated as if you were in the U.S. It's very similar to being here to be treated for a medical condition. It won't count against your days. It will be presumed you plan to leave the country, but were prevented to do so. So up to 60 days, beginning there on the 1st of basically 1st of February and through the 1st of April, those 60 days, you're allowed to just kind of count that as if, yeah, I wasn't here. Now, obviously, after 4/1, we have a problem because if you're still here and you're still here now, then you may still run into a problem. This doesn't solve everything. The theory being that it delayed you in getting out of the country, but you still could get out of the country eventually for the most part. So the idea was that if you stayed here for the whole 60 days and you're still here, that maybe you really didn't have the intent to leave. So yeah, they're restricting this. But as I say, you get your presumptions. This will allow you to file Form 1040-NR and only pay tax on U.S. source income. That's your nicey. Well, like I said, it's CPE time. And actually, it is CPE time. And I have 4 different sessions scheduled to go over the tax laws that have changed since last you got your tax update, which is mainly COVID-19 and the loans. But we'll talk a little bit about the Secure Act as well. And I'm running it for 4 different state societies. The first one is coming up this week on April the 30th and May the 1st. For the New Jersey Society of CPAs, it'll be a webcast going in the morning on 2 straight days. Now, it'll be 2 4-hour sessions. It's really the single 8-hour course in many ways, but broken into 2 parts. So if you can't attend both, you can attend one or the other. The first session will deal primarily with business issues, which will be the loans will be in that session, along with the payroll tax, along with a lot of the patches that we found in the patches to TCJA issues. The second day, we'll talk about other things that impact individuals. right? So we'll talk a bit about the individual coverage, things that are individual related. That could cause individuals an issue. We'll also talk about on that day the things related to the Secure Act. So we'll talk about the individual issues that come up under these COVID-19 type of things. We'll then talk a lot about we'll talk some too about the Secure Act. Because remember that thing that was out there and changed retirement plans and caused us all kinds of trouble and that we were all really, really upset about? It's still there. Okay. Now, the Arizona Society will put the whole thing on one 8-hour day on May 7th. So you can sign up there on the Arizona website for that. And that'll be essentially the same topics, except in a single 8-hour course instead of in 2 separate 4-hour sessions. We'll then do what is we mentioned last week, the single 8-hour course, but this will be a 4-hour split over 2 days, but you sign up for both automatically. So this will go on May 19th and 20th. And finally, for the Washington State Society of CPAs, we're going to do a webcast on May the 27th. And that will also be a single 8-hour session, very much like the Arizona session. It'll go the full 8 hours, and we'll again talk about these things. So again, we have these 4 state courses. Take a look. If you're in one of these states, sign up. It is a webcast in all cases at this point, largely because, you know, we still, in every case right now, every one of these states that I'm talking about is under a lockdown, and none of them have at the moment said that we'd be able to do a non-lockdown. There's also the problem that you can't really travel's kind of quirky. And actually, as I understand my case here in Arizona, if I actually went to New Jersey, I would have to be quarantined when I got back to Arizona for 2 weeks. So, because they consider New Jersey to be it is a hot spot, as we say. So you're going to be stuck in quarantine, so that would also be a problem. So for all that, all of these will be webcast. They'll be webcast via usually the system that the state society in question is using. So if you've had webcast in those societies before, you should be aware that we'll be looking at those same things. So, we expect to get back to true live sessions eventually, but it's probably not going to be in May. So we are going to do all these May sessions will be webcast. So this has been the current federal tax developments for April the 27th, 2020. You can check for regular updates at currentfederaltaxdevelopments.com on the website, and we'll keep posting things. I'm going to tell you right now, there's already been an update since I wrote everything up for this week, for this session. We did get guidance on maximum loan funding, how much you could give in a loan for various entities under PPP, which is, as I said, tongue-in-cheek, only 21 days late. We're a little 3 weeks late on that, but we'll talk about that next week. We'll see other things that come down. I do expect more things to happen. The IRS has been very active getting guidance out. I expect that activity to continue. From the IRS standpoint, we'll probably see some more things from the SBA, and maybe if we get lucky, we will see the repayment aspects of this, because that's becoming a major problem. I've been told by multiple people that ever since question 31 came down, that the banks, if asked about, well, will this work for repayment, they're simply refusing to answer, or even better, saying, well, that's for the accountant to tell you, which I will be totally honest is a total cop-out, because it's very clear under the law that the bank is the one that will make the call as to whether the debt will be forgiven or not initially. So bottom line is, I can't really tell you the bank's going to make the call. And if the bank doesn't think this counts, then it won't count. But right now, I think the banks are afraid that SBA guidance is going to come. And if they say anything right now that, in a week, 2 weeks, maybe 8 weeks, there's some SBA guidance will come, and whatever they said is dead wrong. So, yeah, we'll hope we get some guidance. You can send any questions or comments to me, edzollers at currentfederaltaxdevelopments.com. You can follow me on Twitter. My handle there is @edzollers. You'll also follow discussion on the subreddit of /r/taxpros. I also follow discussions on the Connect websites for the Arizona Society of CPAs, the New Jersey Society of CPAs, looking every so often on the Minnesota Society of CPAs, and also the discussions that go on the Tax Talk news group for California. So any of those, if you're there, you want to ask questions, you can. We've had lots of discussions going on about the loan programs, things that have come up, and just kind of, and a lot of cases, especially locally, sharing stories about, okay, who's had success, what banks appear locally to have been the ones that have been best at getting PPP loans funded and have taken care of companies, because we've had a lot of issues where clients have had big problems with the big three banks, the big three, Chase, Bank of America, and Wells Fargo. They've not been happy with how that's worked. So we've had people now looking for new banks to work with, and so we've had a lot of talks about banks that may have worked better in their various locales. So certainly those local discussion boards, if you have access to them, incredibly useful. But otherwise, it's another week in whatever this is, I guess, stay at home, quarantine. We're not quarantined because we get to leave. If you're actually quarantined, yeah, it gets worse. But we're in this sort of shelter at home time. So hopefully you all are staying safe, figuring out this whole working from home routine, and getting all your tax returns and other things taken care of. And we'll be talking to you again next week here on Current Federal Tax Development.